am now the wrong side of 50. The one thing that I wish I'd done was start an awful lot earlier. I suppose this is the key bits of advice is do not just FOMO into things, so the fear of missing out. Do you think you'd rather have individual stocks in here, or would you rather just have ETFs? As I started to build up a little bit more knowledge, started to then look at sort of dividend stocks. And investing is a long-term, it's got to have a long-term horizon. Have whatever your strategy is, and you pay yourself first. Paycheck comes in, you don't even need to do anything. It's a set and forget.
Investors, welcome back to another go-round of Masters of the Market. This week, I am absolutely thrilled to welcome Mark onto the show from Desperately Seeking Financial Independence. He's got quite a channel. Mark, I first want to welcome you to Masters of the Market, and thank you for joining me. I'll pass the first question over to you, as I always do, and just ask you how you got started and where you're at today.
Yeah. So I suppose, how did I get? First of all, thanks very much for bringing me on the channel. I don't know, I feel a little bit out of place with all the people that you've interviewed so far who have got great stories. But I suppose mine starts back during COVID. We were obviously all stuck at home and started to have money not being spent. So we sat down and we found this book by Scott Pape, an Australian who talked about the barefoot investor journey, and that sort of sparked an idea in our minds of we could get rid of an awful lot of debt that we had. We had sort of 16,000 pounds of debt, and we managed to clear that in a very short number of months because we weren't spending a great deal of money on the things that you would normally spend, because we were in the UK, we were allowed to go out for 1 hour a day, so there wasn't much money being spent and still working away. So we went from there and we started following these barefoot steps. I cleared off the debt, got some emergency fund there, and then invested bought with cash a small camper van, and that's what sparked the whole idea of what does financial independence actually look like for us. We still work, but we've managed to sort of build up clearing all that debt, building up an emergency fund, and in comparison to some of the other people that you've had on, quite a modest sort of investing portfolio of about sort of £65,000. So working well towards that £100,000 mark that everybody thinks is the really difficult one to get to.
Mark, I feel like you almost sell yourself short in terms of when you're comparing yourself to other guests on the show. So I'm going to go ahead and just boost you up a notch. You have quite a story and you have amazing content. So anybody who's out there looking for some really solid financial insights, advice, words of wisdom, you have to check out Mark's channel. I'm going to go ahead and, of course, pin the channel down in my pinned comment for everybody. But Mark, what strikes your curiosity or interest in finance to begin with?
I think in the past I've dabbled in real estate and things like that, and had my fingers burnt at that stage. And it was just, I am now the wrong side of 50. And the one thing that I wish I'd done was start an awful lot earlier. So as we got into this whole barefoot investor and financial independence journey, we went, actually, I've got 2 kids as well who are teenagers. And I went, let's try and start setting them up as well. So we're quite lucky in the UK that we've got the ability to open junior stocks and shares ISAs. So we've started putting money into that for the kids and start trying to bring them on that journey of what's finance all about, because schools do not teach us any of this. I think previous guests have also said, like, we go to school, we get taught that you need to go to university, get a job, work till you retire, take your pension if you've got one, but why not try and take control of that and control of your own journey?
And assuming that you get to this financial freedom number for yourself, what does financial freedom really look like to you? Because I feel like a lot of people think it's the classic sit on a beach, do nothing. What does it look like for you?
Um, Myself and my wife actually enjoy our jobs, so we've had this conversation recently. Are we already financially independent? I know there is that whole trading your time for money piece, but in reality, we think we're already there. If we want to do something, we've got the finance there to do it. I think we'll move more to a sort of a barista type of financial independence. So having a bit of a side hustle or a side job, doing that part time, which then allows us to go off and do other bits and pieces that we want to do a little bit more travel, and sort of take in quite a few more sort of city breaks, I think is what we're looking at. I've got kids who are getting closely into their education, so hopefully they'll move off, and sort of get jobs, and become a little bit more financially independent themselves.
Sure. Now, when it comes to finances, I feel like one of the steps that a lot of people often overlook is like taking care of business before getting invested in the stock market. Now, you have experience there of doing just that. You had the 16,000 pounds worth of debt. I want to know how you conquered that debt, how you would advise for other investors to do just that before they get invested, or would you share that you could do both at the same time and you should just get invested immediately?
I suppose this all depends on what your financial goals are going to be. What is it that you actually want to do? So there's obviously the two different ways of dealing with your debt. You can have the snowball or the avalanche. So you can be looking at picking whatever the smallest amount of debt is, and sort of knocking that off, or you go for the one with a higher interest and start knocking away at that to start off with. It all depends on what your personality is. Do you need little kicks of endorphins to keep you all motivated? If that's potentially get rid of your smallest step first and sort of build that up. Um, we we basically went for that. We went for picking off the smaller amounts of debt to start off with, because if you think of what dividend investing is like, it's you get those little endorphins as the dividend lands in your trading account. So we went for it that way and sort of just started working through that. We were quite lucky because, as I said, it was during the COVID period, so we were still having our wages coming in and we didn't have all the expenses that we would normally have had. But other ways, other things that you can do if you're trying to get out of that debt side of things is, just go through your bank statements, figure out what are those bits on there that you don't even know what they are. They're direct debits that you set up 10 years ago that are still running, and every little bit comes together to just help you create some more money in your account to be able to knock another $5, $10 off that debt, or look at potentially getting a side hustle. And there are hundreds of them out there, and people go and start a YouTube channel. A YouTube channel is very hard work, as we both know. It takes an awfully long time to get some traction, and the ad rev isn't brilliant. But yes, there are lots of different side hustles you can go and do, just to get that little bit more money, or go and be a little bit necky and go and ask for a pay rise. You never know, you might manage to pull off a few extra pounds a month, and that just all helps to get things moving. And on your question, can you do the two together? I suppose it depends on what is that figure that you have once you've done your budget. Do you have enough to pay all your essentials, have some money for yourself, and then have some money to either save or invest? And within saving and investing, you could potentially have, as Scott Pipp says, that fire extinguisher in there that sort of gets rid of your debts.
So, Mark, you mentioned dividend investing, and what I always like to say, the dividend dopamine hits, if you will,
Yeah.
where every time you get that dividend distribution, it's like, and you keep going with it. And it's likewise when you're paying off debts. I mean, you're just seeing your progress. Did you get started with dividend investing right off the bat? How did you start investing in the first place? And would you recommend the path that you took?
I would definitely not recommend the path that I took. So if you think about the period in time that I started investing, it was crypto time. So I started off putting money into crypto, and I suppose this is going to be one of the key bits of advice is do not just FOMO into things, so the fear of missing out. Don't follow everybody else. I would recommend that you do some form of education of yourself. That's probably going to be the best investment you're ever going to make in yourself, and you can go and get yourself go and look at lots of different websites. There are lots of different books out there as well, and I've now read quite a few. I've got a big pile of them here. Some of the key ones that I would have read away back at the start. So I started off with crypto, and then went, don't this, then big drop off in the value of that. Fortunately, it started to come back together with the recent rally that there's been in Bitcoin, etc. And I still hold a small proportion in sort of those more volatile types of investments. But I then started doing some reading around and then started off initially going into exchange traded funds and sort of trying to do that the whole Jack Bogle sort of invest into a whole index as opposed to trying to pick individual stocks. And then as I started to build up a little bit more knowledge, started to then look at sort of dividend stocks and investing into those.
So now, do you still hold any cryptocurrencies, or are you totally void of
I've
any meme coins or bitcoins?
I've got a little bit of Bitcoin, Ethereum, Cardano, and still have a bit of Shiba Inu, and that's probably about it. It makes up about, depending on how volatile it is, anything from about 6 to 10% of the portfolio at the moment. And I'm looking at trying to reduce that down and probably just going into Bitcoin and Ethereum probably.
Sure. So if you were to restart, because I'm curious with your story, right? It's like you jumped into Bitcoin. Okay, you had some realizations there, and then you doubled down on the ETF route. I'm big into building what I always like to call is the investment foundation, and that's get your hands on I don't know the S&P 500 or maybe the total stock market.
Yeah.
Would you recommend starting with ETFs or just going this individual stock route? Because I think again we find a lot of investors who want to just get going, want to start investing, want to become what I always like to say, get rich by Tuesday, and they want the million. They want the big bucks. So how do we get the big bucks now?
I am switching back more towards an ETF focus and probably just going for own the world and do just an all world FTSE or something like that that just covers everything. Um, it is very difficult to pick stocks. And within your portfolio, you will have some that might do really well and others that will completely bomb. So you are better off having that diversification through an all world or a specific index like the S&P 500. Um, they have done particularly well over the last year. I think sort of about 27% for the S&P 500 and somewhere in around 20 for the all world. So I think that's what I would be recommending. And I think if we all think of some of those theories out there and looking at probably about 80% into ETFs and 20% into individual stocks.
Can I ask you, Mark, what do you think one of the biggest mistakes investors are making on repeat, and how do we avoid such mistakes?
I think it's jumping on the bandwagon. What is the hype? There are so many stocks out there that you will get somebody will come on and tweet about it, and then everybody jumps into it, and you end up with that whole fear and greed piece with everybody trying to get in. And what do? They tend to buy in towards the top, and then it starts to drop, and then what do? They then sell out at the wrong time. This investing is a long-term. It's got to have a long-term horizon. If you're looking at money in the next 5 years, don't be sticking it in to stocks. Look at getting yourself a reasonable, particularly in the UK, a reasonable interest rate, say in something like a cash ISA.
Is there a way for us to train like and I often have this conversation with a lot of investors, but is there a way to actually train this emotional type of reactions to these market swings, or do we just avoid them? Avoid them by going right into ETFs.
And that, I think, is where I'm going to now. That's one of the main reasons that I'm starting to look at ETFs. It's very boring, but in the long term, you potentially end up having better returns. I can have a look at the two, and my ETFs have done better than the majority. I will have one or two dividend stocks that have really pulled me down in the way that I get returns from what I've invested. So yeah, I think it is, have whatever your strategy is, and basically with many of the platforms you have today, you can just you pay yourself first. You have paycheck comes in, you have your investing money goes into your trading account, and it automatically buys into those ETFs. You don't even need to do anything. It's a set and forget, and just that takes all the emotion out of it. And then you just wait for those dividends that come in when those ETFs pay.
I'd love to know, when you originally set your portfolio up, did you build up these dividend positions, and now you're leaning more towards the ETFs? And if that's been the case, where are you at now in terms of the structure of your portfolio? If you can break it down for us.
Yeah. So I suppose I did initially start, because I started on Vanguard, so you could only buy ETFs on there. And because within the UK you have your ISA allowance, so your individual savings allowance, and you're allowed to at the moment put £20,000 into that tax wrapper. So I'd initially managed to drip that in, buying into ETFs and some index funds within the Vanguard platform. So I had started off that way. I then moved over to another platform after about a year, just to get cheaper platform fees, and started to go into dividend stocks at that stage. So I think I'm probably sat. Just grab a quick look. So currently I've got it set up. I've got an emergency fund set up, and that's got about 18 to 20% of my holding money in there, just in case I need to get my hands on it. And that's sat in a cash ISA, getting about 4.9% return on that, and that's tax free because it's within the cash ISA side of things. Individual stocks about 42%, depending on how they're doing on any given day, and then about a third in ETFs at the moment. And as I said, I think it's about 7% of crypto in the wider portfolio. So I'm starting to shift more towards investments into an all world ETF on a monthly basis now.
So right now,
I will take the dividends that are coming out from the dividend stocks and reinvest those back into dividend stocks.
So right now, how many individual dividend stocks do you have in the portfolio?
Too many. I think I have, it's about 20, 25, 26 individual.
Oh, that's not that bad.
Yeah. Some of them are getting close to potentially taking them off, and I suppose my largest holding is Realty Income, where I've got about 170 shares in that. So very nicely, it is dividend day today. So I'm just waiting on £30 coming in from Realty Income, and I'll probably reinvest that into think the JP Morgan income side of things, and GGI, just trickle that back in there. So I've got that, and then next highest holding I think is the S&P 500, which is literally, it depends on the day. They sort of change their positions on whether they're first or second.
Sure. Can you name some other of the dividend stocks, individual dividend stocks that you have in your portfolio, Realty Income being one of them? Well, what are
Yeah,
like the top, I don't know, handful of individual dividend stocks you have?
yeah. So top ones that I've got, obviously Realty Income. I've then got Legal and General, one of the insurance companies in the UK. British American Tobacco is up there as well. And then I've got a couple of investment trusts. So I've got UK, Greencoat UK Wind, and the Renewable Infrastructure Group. So looking at what is going to be happening with the UK government trying to move towards sort of net zero over the next few decades. So looking at investing into that. And then National Grid, they are upgrading lots of their infrastructure and did sort of a massive incentive to investors, so managed to buy in at a reasonable price for some of the stocks that I'd held already in that company, as they were trying to raise about £7 billion for infrastructure upgrades over the next decade or so. So that's probably the top five that I've got in there.
And how, when you were looking for dividend stocks, shopping the market for them, how did you know which ones to invest into and to actually build your portfolio with? Because there are thousands of stock opportunities out there. And typically, you see a lot of investors go to YouTube or go, I don't know, to Seeking Alpha or any of these other sites and type in, stocks to buy now, and they add them to the list and they're just investing into them kind of without any real insights into these companies. How did you pick your stocks? Why are
Yeah.
they in your portfolio? Give us some insights there.
Yeah, I suppose having a YouTube channel has sort of driven me towards having to do some additional research myself so that I can sort of pull together some of the videos. So what I was looking at is I was basically looking at dividend companies, and if you look at my portfolio, the majority of them are UK biased, because obviously there are withholding taxes for the dividends if you hold them outside of the UK. So I've looked at larger blue chip companies. I've also looked at what's their dividend history like. So have they managed to grow their dividends over the past number of years? I'm particularly looking at long. Did they survive through COVID? If they were around, what did they do during the financial crash of 2008? Another key bit is, are they actually, what's the dividend growth rate looking like? Is that going up? And I'm sort of aiming to try and get that up around the high single digits, if not even better. And I think your one of your recent videos looking at PepsiCo with that 11% dividend growth rate in there. So looking at that kind of growth rate so that the income is also growing over time. Also looking at economically and financially, what's the company looking like? So what's the payout ratio, and what is the debt to equity looking like? Because what you're wanting to do is make sure that they are not using everything up to pay the shareholders those dividends, so that if something does happen, you are reasonably happy that they're going to be able to continue to pay that dividend out. And I think that is, particularly as I move towards the properly financially independent and don't have a full-time job anymore, if I'm relying on some of the income coming in from the ETFs and the dividend stocks, I am looking at making sure that I don't get big drop-offs if something happens. And that's sort of what I've been looking at within the companies. And do they have a strong competitive advantage? Is there some form of economic moat in there? And then finally, on some of the investment trusts that I've invested into, what is the management looking like? Or have they got a strong track record? And also keeping an eye, because several of the investment trusts that I'm invested into, the management have been there for 20 years, have shown really good growth. what does the succession plan then look like when they eventually decide to retire? Because that is, particularly with investment trusts, something that sort of causes the share value to drop. So it's just making sure that it's strong management that you believe in.
Now, dividend yield really wasn't in that list, and I got to
Yeah,
ask.
it, 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 I have some dividend payers in there that have really low. So I've got things like SML is in there with a relatively small dividend yield. I tend to look somewhere in the 3 to 7%. I'll be looking at sort of that being the range, but there are other companies that will come in there and sort of fit into those individual stocks just because think of ASML and its competitive advantage that it has. That's one of the reasons it's in there, and it's also dipped quite a bit recently. So I've been adding a little bit more to that. That's probably in around the number 10 spot on my individual stock holdings at the moment.
It's interesting because even I myself, I classify myself as a dividend investor, but in terms of dividend yield, like that's actually not one of the prereqs, or at least to have a higher dividend yield. And that's I feel like prompted a lot of at least my viewership on YouTube to kind of question, is this guy still a dividend investor?
Yeah.
And to them, I say, I'm aiming for lower dividend yields at this point in my, on my journey, because I'm a younger investor and I want to invest more in dividend growth stocks so these stocks grow. But with that, even just coming around to the idea of what it really means to be an investor, and it's coming down to, are you investing into high quality companies? So I'm not really investing for the dividend yield to be, I don't know, 9, 8, 7+%. I'm looking for quality and sustainability in the dividend. But when it comes to you, I mean, like I said, you didn't even mention dividend yield. So what's your take on what it means to really be a dividend investor?
Yeah, and I suppose this is, are you going for that yield or are you going for the growth? Is the growth more important so that you've got a company that is showing the history of growing its dividend over time? Because if with that, you will potentially also see a little bit of growth in the company as well. That said, if you look at the 5 companies that I gave you, they all do have higher, and actually some of them, so Legal and General is up around the 10% mark on a dividend yield. The 2 investment trusts are probably at 7-8%. Realty, 5.5%, and National Grid somewhere in around that as well. So I do have some that are at that, but that's not the main reason behind it. It's looking at the company, that competitive advantage, and is it growing its dividend yield over time as well.
Do you think this is an area in which dividend investors are too focused on, this yield?
Beginners, potentially, because you come in and you want, because you're probably coming in with a smaller amount of money to start off with, you're wanting to see some kind of return, and they go, oh, that big figure is going to be much better for me, without understanding the whole, why have they got that big high dividend yield? Is that a trap? Is there potentially going to be something that goes wrong and they don't manage to do that? And I think that's sort of what I've seen. I've started to buy into quite a few of the house building dividend stocks. Well, they used to be dividend stocks. They are not at the moment, but UK government is on a big drive for 1.5 million new homes in the UK over the next 5 years. So the UK house builders are going to have to start taking off. So that sort of breaks my thesis on that dividend growth rate piece. But that is a specific condition, market condition that I'm looking at, hopefully taking advantage of.
Now, initially, when we were talking about the size of your portfolio, I actually thought you were going to present a much bigger number in terms of holdings, but you only have around 20, 25 stocks, I believe you said, around 20. Um, the question I have for you here is how'd you get to that number? And is there really a sweet spot for investors to be able to maintain their portfolio? Because I've had some guests on here that have, well over 60, 80, one even over 100 positions. For me, I feel like that's way too much to really manage. You're actually in the sweet spot of what a lot of investors say is like the average, but how'd you get to that number? Are you trimming down? Are you looking to actually shave down the portfolio to less than that?
Um, I suppose YouTube's driven me slightly to increase the number that I originally had. I've got a monthly dividend pie in Trading 212, where I think I've only got about 10 or 12 stocks in there at the moment, and that's sort of where I began. I've then started to look at the house builders, so I've probably got another 8 in there. And then I've got a couple more growthy type of stocks as well. So that's sort of how I come up with the sort of 25 that I have. It all depends. Do you want to keep a tighter circle of competence or not? And it comes down to that. Is 10, 15 a sweet spot? There are some people who hold the majority of their holdings in a couple of stocks and do particularly well from that. So it all comes down to what is your strategy all about, because everybody's approach to this is very personal.
Now, you shared a little earlier on that you're working more towards building up positions with the ETFs that you have. Is this something that you foresee in the future? The vast majority of your portfolio will just be ETFs, and is it really worth? I mean, I just created a video the other day. Is it really worth investing into individual stocks and potentially risking not at least outbeating the S&P, or is it just worth sticking to ETFs, like broad market ETFs? Don't even have to look at the market. Why would someone even want to choose to go down this individual stock route when we have these ETFs?
Yeah, and this is that big question. Like, for 90% of people, they probably should just set up to make that purchase once a month or whenever you get paid, and you just buy into that ETF and just accept that you're going to whatever the market does. That's basically what you're going to get as a return. And historically, if you look at that in around your 10%, I'd be very happy making 10% every year. Look at what that will do if you compound that over time. Even if you're just putting in a couple of £100 a month, you're going to end up in 45 years. I know it sounds like a really long time. You're a millionaire. But if you've got that long time horizon, am I still on camera?
Yeah, we're still on.
No, it just flashed up and said it had gone. um, yeah, so it's for the majority of people that set and forget plan on ETFs is probably the best way, and just have a little bit of fun money on the side. And as I said earlier on, maybe you do 80% in the ETFs, and then see whether you can beat the market with your 20%, and that just keeps it a little bit more interesting. And I think that is sort of where I'm going to be trying to move towards over the next couple of years. The majority of my money going into ETFs, with only a small amount staying within that dividend portfolio that I have.
Now, is that just out of sheer interest to, you have interest in other areas of your life and you don't want to spend as much time in the stock market, but you also know you can make the 10%? Like, I guess what I'm trying to get to the bottom of is, and I've been thinking about this a lot lately, so many people, because we're trying to get rich by Tuesday, we're trying to pick the winners, find the needles in the haystack. I don't think we do a great job.
No,
But
we don't.
with that said, have you come to this realization that, like, hey, you know what? Maybe it's just easier to go the ETF route, because at the end of the day, it's almost a guarantee. You can't
Yeah,
lose.
yeah, yeah. If you look at what history has done, it's continued to keep going up through world wars and everything else that we've been seeing going on over the last 5, 10 years. Um, it has continued to go up. There will be times when it comes down, and I think when I started on the Vanguard platform after COVID, I took quite a substantial drop as the market went into a bit of a correction, and that was after the COVID period because I wasn't actually invested during that period. So it's the whole psychology bit. If you're in individual stocks and something happens, you could see your portfolio have even worse if you're in something like crypto. I think at one stage I was down 90%. And it really comes into psychologically, it is much easier to just be in an all world or an index fund, and just have ETFs that sort of track the market.
The window of time you used was 45 years to be a millionaire. If you're just continuously investing, which is,
Yeah,
of course, I mean, that's just the reality. Time takes time.
yeah,
And as long as you're investing almost a minimal amount, you
yeah,
will eventually hit millionaire status. There's nothing wrong with that.
yeah, yeah.
How do we train patience?
I was going to say, go and have a look at the psychology of money. It it is something you just need. If you're in this to make money, it takes a long time. And compound interest, go away and have a look at that and see, plug it into a compound interest calculator and see over time if you're just putting in 200 pounds, $200 per month and giving yourself a 7 or 8% return or a 10% return, just see what happens as you're getting into the 35 year time period. Because I think when I plugged it in earlier on today, it was over a 7 year period, £500,000 goes to £1 million. And that's by you only putting in £2,400 a year. It's the compound interest that is just flying in there. You're making £40,000 a year, just from compound interest. It just takes time. We are in a world where you can press a button and you can have Amazon deliver something in a few hours or the next day. We need to start getting used to, you don't get things automatically. Take a pause when you see something you want. Take a pause. Do I really need it now? Think about it. Sit on it for 24 or 48 hours. Do you need that new watch? Do you need that new phone? Potentially not. Patience.
I'm curious to know in your personal life when you're out shopping or like, even saving money, paying down debts, like having the full scope of your finances. What have been some things that have really been either an eye opener for you or just have changed the way that you look at the world around you because of, I mean, finances? You're seeing, for me, it was a lot of like materials just don't really make me happy. What makes me happy is this idea of just buying my time back. And so for me, when I shop, I'm like, it's a no brainer. I don't really need, some of these things that I think I need. Therefore, I'll invest it. What was it for you? Same experience?
Similar experience, and it was also when I started sort of pulling off, having a proper look at bank statements and doing a little bit of budgeting. It was, whereabouts is my money going? Do I really need to buy that coffee every day? Do I need all of these different streaming services? Because I can only watch one at a time. And maybe I bounce about between them and go, right, I want to watch that series and then this series. So the whole idea was, how can you reduce those overheads? But also, how can I get a little bit more money on the side through several different side hustles? And I think I've got about 7 running at the moment.
Wow.
They don't bring in a great deal of money, but there's just a little bit, and I still get excited when I get £10, $10 from something on the side, and then just stick that into invest. And I think, as I said, if I'm having a look for something, like I had a watch that was broken, a Fitbit watch, and I was going, do I really need a new one? Do I really need a new one? And I think it was 6 months before. I ended up replacing that as I got into a little bit more fitness, and sort of help track a few things. But yeah, it is trying to put off those impulsive purchases. I drive my camper van's 20 years old, and the other car that's paid off is nothing flashy. It's just a little drive around to get around the town. You don't need to invest in really flash things. Millionaire next door example. Look at Warren Buffett. Does he dress up in the nicest suits and all the rest of it? Does he drive a big flashy car? No. He's using his money to build him wealth in other ways.
You know, I almost feel like everybody, like we always look at Warren Buffett as the example, but we never actually follow suit in his ways. You know, like we look up to Warren Buffett. Yeah, what does he drive? You know, he's always at McDonald's or he's always got a Coca-Cola. Like these are the things that just make him happy, bring him joy, and then everything else right into investing. But no one really like conceptually follows through on this. And we're like, yeah, billionaire, right? Like a very wealthy individual. Let's use him as the example. How would you recommend that we actually get cracking on using our idols or the exemplary figures in this industry instead of just talking about them? Like, how do we actualize on them?
Yeah, and I suppose it's some of the things that I look at in those individual stocks are some of the things that he's looking at. So he will pore over statements, and see what is going on within the company. So I've started trying to do a little bit more of that. So looking into things like annual reports, and doing a little bit of a look at it, not the same level of depth that he is, but that looking at companies with competitive advantage and looking at things that have got sort of that economic moat, and start looking at it in that way. And I think from some of the things that I've read, I don't go out and buy flashy cars. I used to. I don't do that anymore, and don't go and buy really expensive clothes and things like that. There will be the odd thing that is a treat, because you can't just live a very miserly life. You've got to live a little bit, and that's sort of within the budget. I tend to look at something sort of 70-20-10. So looking at, well, it's probably going to change a little bit. 65% on essentials, possibly 20 on want some of those things for ourselves, and then probably about 15% into the investment side of things.
Do we need to experience these like kind of materialistic purchases to get it out of our system, do you think?
I think we do. I have two teenagers, as I said, so I am trying to slowly bring them round to the fact, and we sit down once a month and look through their junior stocks and shares ISA and go, right, so this is how things are doing. Do you think you'd rather have individual stocks in here, or would you rather just have ETFs? And we have those conversations about things that they're invested into, but also attempting to stop, particularly they are on TikTok and all the rest of it, and are used to scrolling really quickly and that instant gratification side of things. So it's trying to teach them at an early age. But yeah, potentially we do need to get it out of our systems, to learn that you are better off, sort of looking at things that will deliver in the longer term as opposed to that instant gratification.
It's crazy to me because I mean, maybe I already had my experiences, my early 20s, but wisdom is in fact not doing the I don't know, say making the wrong moves because someone else shared with you that they've been down that path. But yet we for whatever reason, it's like we always constantly find ourselves in the position to need to figure it out for ourselves. Always beyond me. I do a lot of reading in that sense, to which you held up a lot of books. I'm curious to know who have been some of your biggest investment idols or icons that have helped you along your journey, or even some of the books that you've read that you can recommend to us.
I think everybody looks at Charlie Munger and Buffett. That's obviously on book side of things. One Up on Wall Street. As I think I showed the Psychology of Money. I actually quite like. There's a UK book by a guy called Andrew Craig, and that's How to Own the World. And that's just a really simple way of how can you have a balanced portfolio, a diversified portfolio. So just looking at stuff like that, quite a few things that I've read. And there is lots of stuff on the internet. Just sometimes take it with a pinch of salt.
Let's talk about that for a quick second. We are both YouTubers. You're even on Instagram as well. People stumble across our pages all the time, and something that I'm big on is knowing who to trust. I'm curious to know from your opinion, how exactly do you know if you're the average Joe investor out there coming on YouTube or Instagram or wherever really? How do you know who to trust?
It's very difficult. It is what are people saying? Are they talking about their journey? And I suppose I sometimes quite worried that I'm quite open with what I've been up to throughout my journey. So I will do my dividend income every month and portfolios every month, and sort of show people what I've been buying, selling, and investing in, but also being very clear that that's what I've done. That is my personal journey. It takes into account what I think and believe in, and it is definitely not something that you need to follow. Go away, do all your own research. There are lots of people out there who are telling you they're going to make you hundreds of thousands of pounds next Tuesday. That doesn't happen in this world. If somebody is offering you something that is too good to be true, it probably is. And I got my fingers burnt at an early stage in real estate, where I think very similar to one of your previous chats. This was real estate that guaranteed income, and I bought one unit, got that income for 2 months, bought another one because I went, oh right, I've tested that, and then the company disappeared, and we ended up being left because they'd done a very dodgy deal with solicitors and everything, and I am very wary now of advice on the internet now, particularly. I was quite a few years ago, when I was much younger, but it was something that sort of made me do due diligence before jumping into any financial investment.
So you also mentioned you have quite a bit of side hustles, and I mean I feel like that's also unique. You shared earlier on, you're on the worst end of 50, but I'd like to say I don't even think there's a worse end to any age. It's all coming with packed wisdom. So yeah. Wisdom and experience for all of us. So thank you for experiencing everything for us. I'm quite impressed though by the ability to actually have quite a bit of side hustles. I'd love to know what some of those side hustles are. It's certainly inspiring to see someone, at your stage of life starting side hustles and on here and doing this YouTube deal as well. It's like proving that it really is never too late.
Yeah. Yeah.
Then there are YouTubers out there, by the way, who are sharing a lot of these side hustles ideas, saying that you can become, I don't know, an instant millionaire. What's been your experiences with these side hustles? What are they? Give us some insights.
Yeah. Maybe they have made millions out of it. I haven't quite managed that yet. So I suppose one of the most visible ones is the YouTube channel. And I started that just over 2 years ago. It's a tiny little bit of revenue that comes in from that, but it's actually quite fun sharing my journey on YouTube. I've recently then started up my Instagram social media setup, so looking at trying to run the two of those side by side, and looking at sort of a little bit more personal finance and financial independence side of things on the Instagram side of things. I've then got stuff like comparison sites, so getting cash back off things. Obviously, through YouTube, we can build up some affiliate partnerships and get money from that. And then just looking at other ways of potentially growing some revenue streams. So just starting to build out some digital products. So things like budgeting templates, ebooks and things like that. Just finishing off a coaching professional qualification as well. So trying to figure out how can I bring that in potentially to help people on a journey towards financial independence. But there is obviously that difficulty of people will want you to tell them what to buy, and that's financial advice and won't be anything that I'll be going down. It's helping people figure out what's their risk appetite, what are their financial goals that they're looking to do, and potentially help them work through some of the budgeting side of things. So that's another one that's coming on in the next few months.
So I have younger viewers, in their 20s and 30s, and I have the elder viewers out there as well who are in their 40s and 50s, which is interesting. It's a very interesting mix, I feel like, of viewers. And I feel like a lot of viewers are out there saying, side hustle, I don't know, but I also don't have all this money to invest. And I want to talk about that for a quick second because you are the evidence and the proof that we need to say, hey, no excuses. What would you say to these individuals?
You need to either cut the amount of money that you are spending, or you need to increase your income. So it's one of two, or why not do the two together and just get that extra $50, £50 a month to be able to invest or save, and then you just start that flywheel moving on the journey of compound interest. There are some very easy things out there that don't take that much time. People are on their phones all the time. Why not go and do some surveys or something like that?
Short, sweet, and to the point. It's that simple. Mark, I want to ask you, we have had, just the other week, we had some inflationary data come out, producer price index, information come out for us to digest. We're moving into, at least in the United States, a new presidency, just a lot of macro events, of course, geopolitics. Do any of these events matter for you as an investor? Do you look to macros at all as you invest, or is it really just noise that we should shrug off?
Great question. It probably is something that we should shake off. It's going to be an interesting 4 years coming up. Let's wait and see. We might get a little bit of a Santa Claus rally coming up. We might see an interesting year next year. Let's wait and see what January does. But if you are invested into ETFs for the long term, you don't need to worry about it. If you're going to be investing into individual stocks, maybe you need to be looking at what kind of sectors may benefit from a Trump administration, and see where that goes. You never know. Tesla might go to the moon.
Mark, some of the older investors who are out there are actually just getting started as well on their journeys. I've had a fair amount of comments come in, or even emails directly to me that have come in where investors are sharing their story and saying, they're in their elder 50s, nearing retirement. Is it too late for me? I'm curious to know, just given where you're at in life, what would be your words of wisdom for these investors?
Obviously, best time to have started investing was way back when you were in your nappies. But the next best time is today. And I'm so glad that I took the bull by the horns a few years ago and started to invest. It's a smaller portfolio at the moment, but hopefully once I get through that £100,000 barrier, I'll then start to see the compound interest really starting to kick in. So anything you can put in, get it in there and get the journey started.
Do you feel overwhelmed at all because you started so late, or is that really at this point, there's no need to even look back, just invest the money, that's it?
I can't change what happened in the past. All I can do is take action now, and make as much of it as I can moving forwards. And that's the whole reason behind the side hustles, just to try and increase the amount of money that I'm able to put into the investing. So see what happens over the next. I'm hoping 5 to 7 years before I can stop the real full-time job.
Sure. Now, if someone is literally a year short or a year shy of retirement or in retirement now, I mean, they gotta. I even worked at a department store at one point in time, years back, and it was holiday season. And I actually remember there was a gentleman, Frank, who came into work, and Frank was in his 70s, and so there really is no excuses. He was there working the seasonal,
Yeah.
department store shifts, and it was really nice to see. But something I spoke to him about was, of course, finances and how what he's doing. And in some sense, he was sharing like, I need to be here. I mean, it was too late for me, but he did start to invest, which was amazing. How would you advise an investor like Frank? Just ETFs? Or should he be going a little bit bigger into, say, individual stocks, just based on the fact that he's going to need more money and more money now?
Yeah, big, big, big question, big decision. Um, the problem, the problem with going for those individual stocks is what happens if you end up with one of them absolutely tanking, and disappearing to almost nothing. At least with the ETF, particularly if you can use any of the tax advantages that you have in whatever country you live in. You are safer sticking with the wider market, tracking ETFs, but also potentially looking at bonds where you're going to get that guaranteed income, each year or over whatever time period you're looking at. And then do you go for your 60/40 split, with 60 in bonds, 40 in stocks, or potentially even a bigger proportion into bonds?
So I just watched one of your recent reels on Instagram, and it talked all about this outdated system of that 50/30/20 split, talking about splits here. And I'm curious to know if the 50/30/20 is outdated, what's now? What's indated?
Um, I am looking at what I'm doing at the moment, and I think I mentioned earlier on. I think on that reel I've gone for a 70% to those essential bills, so all your household bills, your transport, food, and electricity, etc. Then looking at, I think I'd allowed 20% for your wants, so that you can live a little bit. Because what we don't want to do is just end up being completely frugal, locked away in the house, and not enjoying our life a little bit. So that's things like your um, TV subscription services, going to the gym, going for nights out, going out for a meal, potentially holidays, and then 10% into the saving. So at least you are starting that, moving forward. And then if you can look at reducing some of those individual bills, potentially you reduce that to 65, and then increase your savings rate to 15%.
This is indated now.
People will disagree. I'd love to hear what people think it should be now, but
Investors, you,
that's based on what I'm up to at the moment.
you got to comment down below to let us know what you think about this new indated approach. And I got to say, when I took finances seriously, about a decade ago, this is something I too looked at and said, hey, is the 50/30/20, really something that is going to help me get to my goals? And it wasn't. It's actually particularly why your video resonated with me so well. I want to ask you, Mark, if you were to actually have an investor and the icon investor for yourself join you at a dinner or have a beer with him or her, what investor, who would it be? What would you talk about? What would be some of the big questions that you would ask?
I don't know. Does everybody go for Buffett? I think I'd rather
No,
actually
not
have.
not everybody. Surprisingly, a lot of people say everybody would go for Buffett, so I'm not going for Buffett.
Yeah. I think I would actually go for Charlie Munger, and just to see what his take on everything was, because he was part of that partnership that has thrived over time, and just see, is there anything really that he would love to have done differently, or was the path that they had taken, were there any real regrets that they had along that route, or was it just everything that they'd had just done everything exactly the same?
Sure.
Who would you go for?
It's a good question. As I think I read a lot, voracious reader, and there's a couple of investors that would come to mind, but one of them would be my grandfather, because he actually created a website a decade ago, on investing and finances, and that just, I mean, he was very frugal, and he had his money right, and I'd want to ask him questions about the mindset of financial frugality. And then I would go with Buffett, but I wouldn't go with Buffett in the sense that I'd want to know his investment takes. I feel like I've read enough about Buffett to know how he,
Yeah,
looks at stocks. I'd want to ask him about life and his perspectives on life, because I feel like, again, when we gain experience in finance and investing, what we really gain are some real insights about ourselves. What are we spending our money on? Why are we choosing to spend our money on these certain things that we are spending money on it? And if
yeah,
we were to refocus or reorient our cash flow, how much better off would we be? That to me is how Buffett really became a very
yeah,
wealthy individual in the first place. It was frugality,
yeah.
it was a money mindset, and of course, then it was on top of
Time
all of that investing
and time.
and time.
He's been going at it for an awfully long time, and that just shows you what compound interest does.
I feel like a lot of investors even overlook that.
Yeah,
We just see Buffett for what he is today. Oh, this billionaire. Yeah, okay, that's Buffett. But it's like no one really notices or takes into consideration that he, at the get go of his investment career, he didn't have, $1 million to throw into
yeah,
the market. He
yeah,
sat for years on high quality
yeah,
stocks. Coca
yeah,
Cola is a great
yeah,
example. Not all of a sudden did he just collect the dividend income. So
yeah.
I'd like to know their perspectives on life more so than investing. Um, that's just me. But Mark, I got one last question for you. I'm excited to ask it. I get to ask every master who joins me here on the channel this question. Put you on the hot seat. If I were to give you 10,000 pounds,
Okay.
10,000 pounds right now, I'd love to know which stock you would invest it into and why.
Am I going to go Bloomsbury? So UK publisher that has the Harry Potter books, and also has the Sarah J. Maas, and it is the last stock that I actually bought. So I bought a little bit more of it yesterday, and I'm just starting to build that up. It's got a small dividend yield, looking at superb growth. Sarah J. Maas's uh, books, several more to come over the next few years. And also, you've got the Harry Potter series coming out. I think it's on HBO or Disney, and they are then looking at that will drive more people back into buy the Harry Potter books, and they're also looking at branching out a little bit more into educational publications as well. So that's BMY on the London Stock Exchange.
Wow, a very interesting pick. One that I would not have seen coming. The Buffett answer, yes, but this one, not so
Yeah,
much. Investors, We have Mark on from Desperately Seeking Financial Independence. Like I said, I will link Mark's channel down there in the pinned comment, as well as his Instagram. Like I said, he's got a lot of insightful information on finances and investing. So definitely go give his channel a look. Mark, I want to say thank you again for joining me on Masters of the Market. And investors, until next time, we will see you all there.